Today it is a kind of trend or fashion that is happening in derivative market. You go and ask someone, hey, what are you doing these days? So the counter person replies, I am trading in options. Wow, you are trading in options, something big. Okay. But out of 100 people who are trading in options, you make them sit and ask some basic fundamental questions, 95 of them won't be able to answer, because they are trading in options just like that. They are not having complete idea about what exactly are options. They don't even know the basic fundamental points involved in an option contract. This is the tragedy. But if you are listening to me, I'm sure you are willing to know what exactly is an option contract, and you want to know not only the overview of option contract, but you want to go deeper into each and every aspect of option contract. Now let me remind you something very, very important. If you are new to this channel, then please find the title of this channel on YouTube, and my humble request that you please subscribe to this channel. This channel is specifically designed and placed on YouTube for the benefit of CA, CFA and CMA students, and this has a big chunk of videos available in the field of finance. And don't forget to push this notification bell, because that will keep you notified about all the upcoming videos on finance. What is an option contract? What are the parties involved in option contract? What could be different types of options? How to define the position of various parties? How to make gains using option contracts? How to make different strategies for optimizing your position in derivative market using options? How to hedge your position using options? Wonderful thing. How to make valuation of options? How to arrive at something what we call as option Greeks? What is the role of option Greeks? Most importantly, when you are actually trading in derivative market and you want to know how to use your knowledge in reality, you need to go with that application of what you have learned. And therefore my objective over here is not to make your knowledge just bookish knowledge so that you go and write exams. My objective is to train you in such a way that you parallelly understand the application of these concepts in real life. So let us begin with the discussion on what exactly are option contracts. Suppose I ask you to play a game of dice with me. You know what is a dice, right? A cube having 6 faces. I don't have to explain you what is a dice. So if I roll a dice, there can be 6 possible outcomes. It can show a number 1, 2, 3, 4, 5 or 6 on its face. So suppose I tell you that you play this game of dice with me, and if you win, I give you 10,000 rupees. If you lose, you don't have to pay anything. Correct? If you win. So when will you win? Suppose the dice shows numbers 2, 4 and 6, you are the winner. That means if the dice is showing an even number, you are the winner. If you win, you get 10,000 rupees. If you lose, suppose the dice shows an odd number, you don't have to pay anything. However, there is a price for playing this game with me. You have to buy an entry ticket to play this game. Entry ticket price is just 500 rupees. You pay 500 rupees and I will allow you to play this game with me. If you win, 10,000 is yours. If you lose, nothing other than that entry ticket, nothing else you have to pay. So you either win or you just entertain yourself and move out, you don't lose. And of course, if you entertain yourself by playing a game, there is always a cost of entertainment. Option contract is all about such entertaining game. This game will let the game player either win or just have nothing. The party to the option contract, who is basically an option holder, will never lose, other than the price paid for that entry ticket. Now this is in reality what happens in option contract. So there are basically two parties involved in an option contract. Not to forget that option contract is not the game of dice, it is actually a derivative contract. So let me remind you what is the meaning of a derivative over here. Derivative is any contract between two parties, so there has to be involvement of two parties. Any contract between two parties that is expected to be settled at a future date, correct? You are going to settle this contract at a future date, and the price at which you are going to settle, that price has to be determined today, that price has to be fixed today, that price has to be agreed today. So let us assume that there is a derivative contract where two parties are involved, X and Y. So I am assuming name of these two parties as X and Y, and they enter into a contract whereby X will have a right, I repeat, X will have a right to purchase 1000 equity shares in a company named NJ Limited. So X has a right to purchase 1000 equity shares in NJ Limited at a price that is already fixed. That is, suppose the price is rupees 32 per share. So X is now going to hold a right to purchase the share. X does not have an obligation. X only has the right to purchase. Now, this contract is supposed to be settled on 31st of August 2022. So when the date arrives, 31st August 2022, there are two parties involved, X and Y. X can behave like a buyer, Y can behave like a seller. Whether those shares will be bought by X or not, that decision is completely based on choice made by X in that example. So in that example, X and Y were the two parties. X is considered to be the option holder. Option holder is the party who has the right to buy, or it could be a right to sell. I have given you an example where there is a right to buy. So option holder is the party that has the right, and option holder is the party who will decide whether to exercise that right or not. So how can option holder be benefited? Imagine the market price of share of NJ Limited on 31st August 2022, that is when the settlement date arrives. Suppose the market price of that share goes to rupees 40, but X has a right to purchase the share at rupees 32 only. So imagine a share whose market price is rupees 40 and you have the right to buy it at 32, you definitely make a gain of rupees 8 per share multiplied by 1000 shares in the contract. Your total gain comes to rupees 8000, correct? Now suppose there is a reverse scenario where the market price of the shares of NJ Limited has fallen down to just rupees 20. That means in the open market the shares are traded at rupees 20 per share. X has the right to purchase these shares at 32. Now of course, if something is available in the open market at rupees 20, you will not want to buy it at 32. So you will not let your rights be exercised, you will let your rights just get lapsed. So basically X in this case will not exercise its right to purchase these shares because the price agreed is much higher compared to what is prevailing in the market. Because X has a choice, X has only and only a right, no obligation to perform. X simply does not have an obligation to perform. X has no compulsion to buy. X has a choice to buy. X has the right to buy. So only when the scenario is favorable, X will buy the share. If the scenario is unfavorable, X will not buy this share. X will just let that right lapse. This is basically an option contract. Other party, Y, will have no role to play on maturity date unless the counterparty, that is X, decides what has to be done. So who is going to decide what has to be done with this option contract? only and only the holder of the contract. So in my example, X and Y are the two parties involved. This option contract is a derivative contract because today's date in my example is not 31st August 2022. It is a later date. So X has the right to purchase an underlying. Underlying is the equity share in NJ Limited at an agreed price of rupees 32 per share, irrespective of the price prevailing on that date. So the contract will derive its value from the price movement of the underlying. I told you, if the price of the equity share on the maturity date rises to rupees 40 per share, the contract will have a benefit in terms of value of rupees 8 per share multiplied by the quantity, that is 1000 shares. It will be rupees 8000 as the value of this contract. On the contrary, if the price falls, the contract will be worthless. Contract is deriving its value from the underlying. It is definitely a derivative contract. It is expected to be settled at a future date. But you know what happens in a futures contract? We have learned that the parties that enter into futures contract, one having long position, one having short position, whether the price goes in favor or not, both the parties will have to perform. On the contrary, in options contract, option holder has no compulsion, no obligation to perform. Option holder is just going to exercise his or her right by choice. So when these two parties are involved and X decides that the right has to be exercised, that is X decides that X wants to buy the share, Y will then be under obligation to perform. That means the counterparty, who is the option writer, will be under obligation to perform only when the option holder is exercising the rights held by such option holder. So please understand one thing, you need to keep a lot of patience because lots of new terminology will come on your way, and we are going to have detailed discussion of each point one by one. So keep that patience. Let me first speak whatever I want to, and then I'll give you systematic notes as well. So in that example which I have just conveyed to you, X and Y were the two parties involved in the option contract. X is the option holder, Y is the option seller or option writer. X will have to purchase this option from Y because Y has provided this right, X has bought this right. This right will not come free of cost, right? The way I told you that if you want to play the game of dice, there is an entry ticket that you have to pay and purchase that entry ticket to play the game. Exactly same way, there is a price for this option that X has purchased from Y, and then only Y will be selling this option to X. So X is the option buyer or option holder, Y is the option seller. Now an option contract will always convey a right to buy or a right to sell. That right can be held by any one party, and that party is called option holder. The counterparty is option writer. Option holder is basically buyer of the option. Option writer is the seller of the option. It is option holder who will have the choice. Option writer will never have a choice. Option holder has the choice. It is option holder who will decide on the maturity whether the option has to be exercised or not. And when option holder decides that the option will be exercised, option writer or option seller is under obligation to perform. So simple point is, the whole benefit is coming in the hands of the option holder, and that is why option holder will have to pay a price to get this option. That price is termed as the option premium. That is termed as option premium. I told you there will be lots of new terminologies that you might be knowing for the first time. Doesn't matter, I'm going to give you systematic notes which will clarify the things. So you need to understand in any given example how would you feature out each and every aspect, and for that reason what I'll do is I'll display that example on screen and the outcome of that example. Whatever I am going to display is basically meant for your understanding purpose only. Don't try to write anything as of now. I'll give you much systematic notes in a while, but let us first go through this example. So as I just told you, whatever I am displaying on the screen need not be written at all. I am going to give you a summarized note a little later. First, just keep observing what we are talking about. So options are such derivative financial instruments that do not bind the option holder into a firm commitment. So we took this example that X and Y enter into a contract where X will have the right to purchase 1000 equity shares in NJ Limited at a price of rupees 32 per share on 31/8/2022. So what we do is we first analyze this example. So we will say here the contract is an option contract where X is an option holder and Y is an option writer. The underlying component in the contract is the equity shares in NJ Limited. This derivative contract is known as call option as it provides a right to the option holder to purchase. The exercise price or the strike price is rupees 32 per share. The maturity date of this option contract is 31/8/2022. Moving forward, we will say on the date of maturity, the option holder, that is X in this case, has a right and not an obligation to buy such equity shares. However, if X exercises his right to buy, then Y will be under obligation to sell. Therefore, the option holder is always at a benefit. For such benefit, the option holder has to pay premium to the option writer. Such premium is payable on entering into the contract irrespective of whether the option is exercised or not. So I told you nothing of this has to be written. Let us just move ahead, and now we talk about the meaning of options. And here whatever I am displaying, this is something that you need to write. So please write, options are such derivative financial instruments that do not bind the option holder into a firm commitment. Option contract provides right to the option holder to buy or sell something in future at a price agreed today. Such agreed price is known as exercise price or strike price. Let us move ahead, and now further we write the heading as parties involved in options. The two parties involved in an option contract are known as option holder and option writer. Option holder is the buyer of the option. Option writer is the seller of the option. So basically, option holder is the one who has the right to buy or sell the underlying, and option writer is the one who provides or sells such right to the counterparty. Let me take you ahead and make you write something more. Options provide the right to the option holder to buy or sell the underlying at the contracted price. The option holder is under no obligation to settle the option contract. The action to be taken in this regard is solely at the discretion of the option holder. The option holder will exercise such right only when it is beneficial for the holder. If option holder exercises the right, then the option writer is under obligation to perform. Let us move ahead and write up the next heading as price of an option. So this could be again a little confusing term for some people who are not clear. See, we have been talking about something called as exercise price or strike price. So when there is an option, whether a call option or a put option, there will be an agreed price to buy or sell the underlying. That agreed price to buy or sell the underlying, that is the exercise price or strike price, correct? However, the price to buy an option is not exercise price or strike price. The price to buy an option is the option price. That option price is also formally called as option premium or simply option value. So option premium is the price that the buyer of the option will have to pay to the seller of the option. In other words, the holder of the option will be able to buy the option only on payment of the price of the option, that is the premium for that option. So in simple words, option premium is the price of the option. By paying that option premium, you can buy the option, not buy the underlying. The price to buy or sell the underlying, that price is exercise price or strike price. So never get confused with the term option price. So let me give you a note on this and please write it carefully. For buying the option, the holder has to pay its price to the writer. Such price is known as premium. The writer of the option will receive such premium. Strike price or exercise price is not the price of an option. Let us move ahead and write further about call options and put options. Now this is something very simple. An option contract will always convey a right to the option holder. The right in the hands of option holder could be either a right to buy or a right to sell. Now some people unnecessarily get confused that holder has the right to buy and writer has the right to sell. That is not the right thing. It is always the holder who would either have a right to buy or a right to sell. To distinguish that, we don't call these simply as rights. There are two specific terms, call and put. So if it is a right to buy that the option holder has, it is considered to have as a call option, and if it is a right to sell, it is known as a put option. In other words, a call option conveys the right to buy and a put option conveys right to sell. So let us write this simple thing as well and then we move ahead. Call option provides a right to the option holder to buy the underlying component at the agreed price. Put option provides a right to the option holder to sell the underlying component at the agreed price. So what is call option? An option that conveys the right to buy. What is a put option? An option that conveys the right to sell. Let us move ahead and now talk about American and European options. So very important terms in option market or derivative market, American and European options. Basically, European options are considered to be very disciplined kind of options. Just like European people, the European options are also disciplined. What is the significance of this word discipline that I am saying? See, there will be a specific date on which these options are exercisable. You cannot exercise these options at any date. There is a specific date. For example, suppose today is 1st October and there is a 3-month option which is a European option. 3-month option, so October, November, December. So by end of December, the option will be matured. That means if it is a European option, on 31st December, this option will attain its maturity and it can be exercised only and only on that date. Not a date prior to that, not a date later than that. Only on that specified date, and such date is referred to as maturity date. On the other side, if it is an American option, American options are not like that. American options are exercisable the moment they come into existence. Basically, it is said that Americans are matured the moment they are born, and so it goes with American options. American options can be exercised at any date up to its expiry. Now, if I am writing an option to you and you are holding that option and such option is an American option, then from this moment, once the option contract comes into existence, from this moment, from 1st of October, if it is a 3-month option, it will expire on 31st December. From now till 31st December, whichever point you want to exercise that option, you being the holder of the option, you can exercise that option at any moment. So on or before the expiry date, these options are exercisable. So basically, with European options, the last date is basically the first and last date. It is called as a maturity date. Only on that date the option will be exercisable. American options do not have the words as maturity date ever. The date relevant for this is the expiry date, because from the moment they come into existence, they can be exercised up to its expiry. So once again, if I am dealing with any option contract which came into existence on 1st of October and it is a 3-month option, if it is a European option, its maturity date will be 31st December and it will be exercisable only on that date. On the contrary, if it is an American option, it can be exercised from now till 31st December any moment, but beyond 31st December it will expire. So when I add 3 months to the contract date, what I get for European options is a maturity date, and what I get for American option is an expiry date. So let us write some notes about this, and let me expand the screen size for your reference. European options are options that can be exercised only at a specified date in future. American options are options that can be exercised at any point on or before a specified future date known as expiry date. Let us move ahead and now write about position of option holder. So what could be considered as position of option holder? There could be 3 types of position of the option holder in the derivative market. These 3 types of positions can be referred to as either in the money, or at the money, or out of the money. So when an option holder is going to be benefited on exercising the option holder's position is considered as in the money. When the option holder is going to incur loss on exercising the option, where the option holder should avoid exercising that option, the position of option holder is considered as out of the money. So simple point, when you are about to make gains from that option contract, your position is in the money. On exercising that, if you are incurring a loss, you are considered to have a position termed as out of the money. When exercising or not exercising that option does not make any difference, your position is considered as at the money. Let me explain this by giving an example, and let us take example of a call option. So in case of call option, what will happen? If there is a call option which will mature after 3 months, when I say mature after 3 months, your brain should work that I am not talking about American options, I am talking about European options. So a call option that will mature after 3 months, it has exercise price of rupees 200. That means, being a call option, the holder has the right to buy the share at rupees 200 after 3 months. Right to buy, no obligation to buy. Fine. If I am this option holder, I am holding this option, I have a right to buy the share after 3 months at a price of rupees 200. Now imagine that the price in the secondary market, that is in the stock market, for that share is 188. I am not an idiot to exercise this option and buy the share at 200. That means my position will be considered as out of the money. However, if the market price of the share is 220 and I have a right to buy at 200, I'll be very happily exercising that option and I'll buy the share at rupees 200, that is the strike price included in the option contract. So in that case, when exercising the option is giving me an advantage, my position will be in the money. So I don't want you people to just memorize this, but for a quick application, try to refer what I am saying. If you are dealing with call option and the market price is greater than the exercise price, you will be finding that you are benefited on exercising the option as an option holder. So option holder's position will be in the money, but when the market price is lower than exercise price, option holder's position will be out of the money. And when market price and exercise price are at parity, option holder's position is at the money. Now, in case of an option holder's position, once you identify, the counterparty is option writer. So simple point is, if option holder is in the money, option writer will be out of the money. If option holder is out of the money, option writer will be in the money. If option holder is at the money, option writer will also be at the money. But when we generally talk about position of any party, we are always concerned with the position of the option holder. Why? Because option writer has nothing to decide, correct? It is option holder who has to decide. So in the market, when there is a data available from the market and you find that there is a particular option that is trading in the money, it is implied that the position has been explained from the viewpoint of option holder. So what I'll do is, I'll just give you a note on this. Please take note of the same. If exercising the option benefits the option holder, then his position is in the money, in short ITM. If the option holder suffers a loss on exercising the option, then his position is out of the money, that is OTM. When option holder is indifferent with whether to exercise the option or not, then such position is known as at the money, ATM. Option holder will exercise the option only when his position is in the money. That means the moment an option holder's position is out of the money or at the money, the option is not exercised. Option will be exercised only when the option holder has this position in the money. So let us move ahead, and now we talk about concept number 4, that is option premium. Actually, I have explained you everything about option premium already with the earlier discussion. So this is an upfront price payable by the option holder to option writer at the time of entering into the contract. By paying option premium, the option holder buys the option and the option writer sells such option. Option premium is payable irrespective of whether the option is exercised or not. In order to decide whether an option should be exercised or not, option premium already paid by option holder to writer is completely irrelevant.